start a discussion about financial calculations with a discussion of interest rates. Interest rates we commonly think of as banking. We borrow money from banks, we pay interest, we loan money to banks through savings, through checking accounts and savings accounts, and they pay us interest. So let's talk about a bank as a financial intermediary. The bank sits between savers that are basically lending money to the bank, and the bank turns around and lends it out to borrowers. In this way, the bank acts as a financial intermediary. Now, the difference between the interest rate they pay savers and the interest rate that borrowers have to pay the bank is their profit. So, for example, let's say they pay you 2% on your savings account, but they charge borrowers 18% on their credit card. That is bank profit. So you can see in some cases banks can be very financially lucrative. However, you don't have to borrow and lend money through a bank. You can go direct from saver to borrower. Anyone who's borrowed money from you directly, or anybody that you've lent money to, circumvents the bank as a financial intermediary. Banks are important because this middle step of the bank being in between savers and borrowers allows facilitation of loans without you knowing each other or having to trust each other. The savers trust the bank lends to borrowers that they believe are safe, and so it acts as financial intermediation between savers and borrowers. The difference between the interest rates is the profit for the bank. We're going to talk more about this difference in interest rates coming up when we add inflation.